Hi, everyone. It's Peter Schiff. It's Wednesday, December 12th, 2012. Well, today the Federal Reserve came out and upped the ante on QE3, although I already thought they went all in on QE when the Fed announced QE3. If you recall, I referred to that as Operation Screw. Well, it appears that Ben Bernanke decided to come out and punctuate Operation Screw with an explanation point because that's exactly what he did. Remember, Operation Twist, which is what gave way to my naming the next operation, Operation Screw, that one was where the Fed was going to twist its balance sheet by selling short-term bonds and buying long-term bonds. Well, eventually you run out of short-term bonds to sell, and so you can no longer artificially influence long-term interest rates without expanding your balance sheet. Well, the Fed now has come to a point where it can't do that anymore, so it announced starting January 1st, as expected, the Fed is going to begin to expand its balance sheet by an additional $45 billion per month as it prints new money to buy up long-term government bonds. That's in addition to the $40 billion worth of mortgages the Fed is already buying with money that it creates out of thin air. So if you take 40 and 45, that's 85 billion a month, multiply that by 12, and the Fed has announced that it intends to expand its balance sheet by over $1 trillion in 2013. Right now, the total balance sheet is a little under 3 trillion. It's about 2.8 and change, which means at the end of 2013, we're almost going to have a 4 trillion Fed balance sheet. Now, it started at about 800 billion before the financial crisis, and it's not going to end at 4 trillion at the end of 2013 because this is open-ended. The Fed basically came out and said that it's going to do this indefinitely. Now, it established two benchmarks for itself, unemployment and inflation, and let's talk about them separately. First of all, unemployment. The Fed said that it's going to keep interest rates at zero, and it's going to keep on printing money as long as the unemployment rate is above 6.5%. But then it actually went on to qualify that. It said that even if the unemployment rate is below 6.5%, that still doesn't mean we're going to take the punch bowl away. Because Ben Bernanke said it depends on how we get to 6.5%. Because he said, what if it's because the labor force participation rate goes down? After all, that's the only reason the unemployment rate has gone down at all since President Obama has been in office. So if we continue to lower the unemployment rate by people exiting the labor force, well, then Ben Bernanke is not even going to raise rates even if the unemployment rate is below 6.5%. Also, he said that even if the unemployment rate were to get below 6.5% legitimately, meaning more people getting jobs, the labor force participation rate growing, even then, he said he wouldn't immediately withdraw all that excess liquidity, that he would do it very, very slowly. Now, if you recall, that's the same mistake that Alan Greenspan made. Alan Greenspan's first mistake was keeping interest rates too low for too long. His next mistake was that when he started to raise rates, he raised them too slowly. If you remember, he was raising rates at a measured pace. Well, now Ben Bernanke is decided to implement that same failed strategy. Not only has he kept interest rates lower for longer than Alan Greenspan, which is a bigger mistake, but now he's promised to repeat the second mistake, and that when it is time to raise rates, he's going to do it very slowly instead of more rapidly. But I think the worst comments had to do with inflation, not unemployment. The target for inflation, according to Ben Bernanke, is 2.5%. But it's not really 2.5%. What Ben Bernanke says is if expectations for future inflation get above 2.5%, that's kind of his benchmark. Although he didn't say, hey, if we hit 2.5%, I'm going to immediately tighten. He's got a lot of wiggle room. But what Ben Bernanke specifically said, and this is in the press conference that came after the official announcement, Ben Bernanke said that he is not going to react to a short-term increase in current inflation. So that if inflation picks up in the here and now, That's not going to worry Ben Bernanke because he's going to look beyond that to the future. And if he's convinced that a rise in inflation today is going to be reversed in the future, well, then he's not going to do anything. In fact, he specifically said that he is not going to look at increases in the price of globally traded commodities. Well, how convenient. That means oil, that means food, basically food and energy. And so if all the money printing creates an increase in oil prices or food prices, Ben Bernanke's not going to care because he's going to look beyond that to some distant point in the future, or maybe 1 or 2 years later, when, according to Ben Bernanke, prices will have come back down. No, he keeps calling it transitory. Ben Bernanke said, I'm not going to react to an increase in oil or food prices that might be transitory. Well, the Fed has been saying that rising food and energy prices are transitory. They've been saying that for 10 years, and I'm still waiting for the transition. The fact is, they're not transitory, they're permanent, and prices are going to keep on getting higher. Also, Ben Bernanke said that he would look towards forecasters as a guide for what future inflation would be. So rather than looking at what inflation actually is, he's going to look in the future at some forecasts because he wants to avoid or looking at the truth of what's going on. He specifically talked, too, about why he wants to use core measures. So he doesn't even want to look at the CPI. So when he's talking about 2.5% inflation, he's not even talking about the CPI. He's talking about these other measures. And of course, what are these other measures? Well, these other measures are the ones that take the price of everything that went up and throw it out. And just look at the prices of the things that didn't go up. Or they use some kind of other method to massage the numbers so that you don't see the inflation. So in other words, what Ben Bernanke said is we're just going to print money and we're going to buy $1 trillion worth of paper every year as far as the eye can see. Because you know what? We're never going to have an unemployment rate as low as the one that the Fed chairman wants. It's just not going to happen. It is impossible right now, given the monetary and fiscal policy. The only way we can reduce the unemployment rate to that level is if people leave the labor force. And he's not going to raise rates based on that. And of course, so the only variable is how long can Ben Bernanke get away with lying and pretending there's no inflation? How much inflation can he create? Because by expanding your balance sheet by over $1 trillion a year, that's massive inflation. That is the definition of inflation. He is inflating the money supply. Prices are going to rise in response to that. The question is, how long can he convince the world that prices aren't rising, despite all the inflation that he's creating? Now, at some point, it's going to be impossible for the measures that he relies on to mask the enormity of the inflation monster that he is unleashing. And the only other reason that we haven't seen a bigger pickup in consumer prices so far has been because we've been able to export a lot of that inflation. Foreign central banks have been buying up these dollars and using the dollars to bid up treasury prices. They're not being used by consumers to bid up the prices of real goods. But all of that is going to change. Take a look at a chart of the dollar. Look at the New Zealand dollar. Hit a new 52-week high today. In fact, I think it's a high for at least 30 years, as long as I've been following it. This is the highest I've ever seen it. The dollar is weakening now against the euro. It's weakening against the pound. And I expect that weakness to accelerate, which is going to put a lot more upward pressure on food prices, on energy prices, which, of course, Ben Bernanke has already said he is going to ignore. He is going to ignore the inflation fire that he lit. He will keep on feeding it with more gasoline and looking beyond the horizon at some distant point in the future when supposedly the fire is just going to go out all by itself. Gold was up today, but not nearly as much as it should have been and not nearly as much as it will be. I think what kind of deflated the gold rally, gold was up maybe about 12, 13 bucks at one point and finished about flat, was that the stock market turned around and closed negative. So I think gold followed the stock market down, but it is going to decouple. This is a very inflationary policy, which I guess from a nominal perspective is bullish for stocks, not from a real perspective, but it is extremely bullish when it comes to precious metals. See, there's normally a lag between creating inflation and the effects of inflation on prices. Now, Now we have a longer lag than normal because all the dollars are caught up in foreign central banks for a while, and it's taking longer for all that money that the Fed creates to chase the diminished supply of goods that we produce in America. But that lag is not infinite. It's going to happen. I think we're going to start to see the impact very soon. Now, some of the other statements that Ben Bernanke made at that press conference that were very interesting. One, I think it was a woman who asked a question of Ben Bernanke. She said, well, how good is the Fed? What's the Fed's track record on forecasting? Because you're basing a lot of this on your ability to forecast. So how good's your track record? Now, what Ben Bernanke should have said, if he was going to be honest, was our track record sucks. But of course, he didn't say that. He basically tried to say that the track record's okay. But he narrowed his time horizon to subsequent to the financial crisis. What he said is, since the financial crisis began, he said the Fed has been too optimistic when it comes to growth, but we've done a better job in estimating unemployment. So he said, all in all, we've done okay. Of course, the Fed chairman completely overlooked their horrendous forecasting before the financial crisis, when they said everything was great, when they said there was no housing bubble, when they said that even if real estate prices went down, it would have no impact on unemployment or the economy. I mean, the Fed's long-term forecasting, particularly when it comes to seeing a crisis in advance or a bubble, like the stock market bubble or the real estate bubble, is horrible. So if they couldn't see the stock market bubble and they couldn't see the real estate bubble, should we be surprised that they can't see the bond bubble, or what's going to happen when it bursts, or what's going to happen when the dollar collapses? Another amazing thing that Ben Bernanke said in response to a question, somebody asked him, aren't you just monetizing the debt? Which, of course, that's exactly what he's doing. But Ben Bernanke said that we're not monetizing the debt. And his explanation was because at some point in the future, we're going to sell all the bonds that we've been buying. Yeah, right. Sell to who? How is it even possible? And it doesn't matter what the Fed claims they intend to do at some distant date in the far off future. What matters is, what are they doing in the here and now? They are printing money and buying bonds. In fact, based on what the Fed has committed, 90% of all the net new bond sales for next year will be bought by the Federal Reserve. Now, if that's not monetization, what is? And of course, Ben Bernanke can't even think about the future, or maybe he can and he's afraid to be honest about it. But how do you sell? A year from now, the Fed's balance sheet is going to be almost $4 trillion. 2 years from now, $5 trillion. 3 years from now, $6 trillion. At some point, if the Fed has to sell that down, how can it possibly do it? Who's going to buy? What are the prices going to be for these mortgage-backed securities and these treasuries? Can you imagine the enormity of the losses that the Fed's going to suffer, that the Treasury is going to have to make up? Interest rates are going to skyrocket. How can the Fed get the economy so addicted to cheap money, right? Get the economy loaded up on this stuff so that it needs a massive dose of monetary heroin just to limp along. And then just when it's the most possibly addicted it could be, then take away the drugs and go cold turkey? It's not even possible. This thing is a disaster in the making. Ben Bernanke, if he doesn't know this, and maybe he's more clueless than I give him credit for, but the truth of the matter is, Ben Bernanke is going to keep on printing money until it's economic Armageddon. That's what he's going to do. He's going to deny there's inflation until it's impossible to deny it anymore. But by then, it's much too late to put that genie back in the bottle without devastating consequences for the economy. Because these are the two choices. These are the only two choices. Because we're waiting so long to do this, we're going to have one of all two choices. We're going to have to raise interest rates dramatically and rapidly. Ben Bernanke thinks when he starts to raise rates, he'll be able to do it slowly. He won't be able to do it slowly, because if he does that, he'll never catch up. When inflation is running out of control, if inflation is 6 or 7%, how's he going to raise interest rates slowly? Because then inflation will be 10%, 11%, 12%. It'll be a moving target that he can never hit. The only way to reduce inflation is to get out in front of it. So if inflation, even if it picks up based on his own measures, if inflation gets to 3 or 3.5% But Ben Bernanke is confident that it's only temporary, that it's transitory, that prices are going to go back down. And so he waits, and he keeps on creating inflation. And then the CPI is 4 or 5%. Of course, by the time that's happening, the real rate is probably 15% or 20, who knows? But let's say we get official rates now of 4 and 5%. And now Ben Bernanke is still convinced that it's transitory. He's still convinced that prices are going to fall a year from now, a year and a half from now. So he keeps on printing. He keeps on creating inflation. And now it's 7 or 8%. I mean, at what point does he admit that he was wrong and realize that it's not transitory, it's permanent, and now he's got a big inflation problem? Now he's got to bring interest rates up. But if inflation is, let's say, 7 or 8%, and he's still got rates at 0, he's got to quickly get rates above 8%. He's got to go to 10 or 12 or 13. He's got to get ahead of the curve to slow it down. If he simply then says, okay, inflation is too high, I'm going to go from 0 to 25 basis points or 25 basis points to 50 basis points, you think that's going to slow down that inflation engine? No, it's going to get higher and higher. He's never going to put a dent in it. He's never going to reach that target unless he gets in front of it. But he can't get in front of it without collapsing the economy completely, which is what is going to happen. Either we're going to have to see a complete economic meltdown, or we're going to get something worse. We're going to get hyperinflation because the Fed is afraid to melt the economy down, and so it melts the dollar down instead. If people think that 2008 was bad, if there was a Richter scale that could measure economic calamities, what happened in 2008 would barely register as a 1 on that scale compared to what's going to happen. We're going to have a 10, right? We're going to have the big one because of what the Federal Reserve is doing. And I think Ben Bernanke knows just how bad it's going to be. That's why he's doing what he's doing. And if you listen to him, more important, if you look at him, if you look at his demeanor, he looks like a guy who's lying. I mean, just look at him. I mean, imagine if you can hook the guy up, talking about a Richter scale or something, if you can hook Ben Bernanke up to a lie detector test when he makes these statements. I mean, the needle would be going all over the place like it was a 10 on a Richter scale for an earthquake. The bottom line to all of this is get out of the dollar. Don't wait, run, get out of it. Don't worry if you're a little bit too early because believe me, you don't want to be too late. I think there's a good chance when the world actually dissects what Ben Bernanke had to say and comes to a better understanding of what he said, particularly what he said about inflation and all the wiggle room he gave himself to let inflation get higher and higher and higher and to do nothing but fuel the fire. People are going to sell the dollar. They're even going to buy the euro. As bad as things are in Europe, the euro is actually going up. And you know what? That's going to take some of the pressure off the eurozone. If we actually see money going back into the euro, that's going to help the European situation in the short term quite a bit. And I think they will welcome those inflows, those capital flows back to the euro. But look at some other currencies outside the eurozone, currencies that aren't printing too much money. I know we're getting a lot of help from the Japanese. They're debasing the Japanese yen. So the yen recently has been even weaker than the dollar. I don't expect that to continue. I expect the yen to strengthen against the dollar, but weaken against other currencies that aren't being as reckless as Japan. Eventually, I think there's going to be a short covering rally in the yen because I think too many people are getting suckered in to the short side of that trade. But you got to get out of the dollar and buy some gold. It is amazing that gold is still as cheap as it is. You can look at gold in the 1700s and say, what is Peter Schiff talking about? That's not cheap because, it used to be 200 or 300. Well, number one, when it was at those levels, they were absurdly low levels. It was the flip side of a internet mania where people had ultimate faith in central bankers and the markets, and nobody cared about gold. So don't even compare it to a benchmark like that. But given all the money that has been printed, not only by the Fed, but central banks around the world, and all the money that is about to be printed, they are going to unleash a tidal wave of inflation. And the best way to float to the surface and avoid being dragged under with the tide is to have a life raft of precious metals. And then, look at other stock markets where you might have some real growth. At some point, and I think it's sometime soon, these Asian economies are going to get tired of propping up the U.S. They will, untether themselves from the Titanic that is the U.S. economy, allow their currencies to appreciate, allow their citizens to enjoy the fruits of their labor, the increased purchasing power that comes with a rising currency and a higher standard of living, that they'll allow that to happen and let the U.S. dollar sink beneath its own weight. When that happens, there are tremendous opportunities. There's going to be a real economic renaissance that's going to be unleashed in some of those countries as they reclaim their savings and their purchasing power and invest in their own economies instead of devoting their resources to propping up the U.S. economy. But that's it for now, everybody. Don't forget, listen to the Peter Schiff Show, schiffradio.com, 5 days a week, 10 a.m. to noon Eastern Time. So I'm able to give far more frequent updates on my daily radio show than I am on my weekly video blogs. Bye for now.